just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving, and the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So
right now, we're exposing a shift that could rewrite the future of silver. Massive, sophisticated capital, hedge funds, sovereign wealth funds, and deep-pocketed investors are no longer playing the paper game. They're taking real physical silver off the market. This isn't just about a price rally. It's a total reset of the market's balance. For decades, silver has been dominated by paper contracts and leverage, but now the metal sitting in vaults is shrinking while paper claims keep stacking up. That gap is the ticking time bomb nobody's talking about. We're seeing record flows into ETFs, private vaults, and secure storage. But here's the catch. This metal is staying put. Every ounce pulled from the system tightens the pool of deliverable silver that backs futures contracts. If this keeps accelerating, one big delivery request could expose a physical shortage, the kind of setup that doesn't just move prices, it can send them vertical. In this video, you'll hear Miles Franklin and renowned bullion dealer Andy Schectman connect the dots. The flood of institutional money into physical metal, the warnings hidden in ETF prospectuses, and the global macro backdrop. Sovereign gold buying, collapsing trust in the dollar, and the early stages of a monetary reset. That's driving the rush into silver. If you're serious about protecting your wealth, smash that like button, subscribe, and tell us what you think in the comments. This is the kind of insight the mainstream still won't touch, and you're getting it here first.
no one really is talking about it, which is kind of crazy. And, look, I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And, when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it makes my disdain for the legacy media grow by the day. Our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from $1,700 to $3,500 an ounce in just the last 3 years. And then at the same time, you got momentum building with guys like Putin and Xi and Modi, who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, done again. And that's, this is what it is. It's not so much gold, it's the dollar, it's everything. Gold is the barometer by which we measure everything else. And when you have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record. Speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. It wouldn't surprise me, and then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. You know, this will probably, I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if you bought the day Nixon closed the gold window on August 15th, 1971? Well, obviously I'm asking the wrong crowd, but number one was gold. Number two was the S&P 500. Number three was the Dow Jones. Number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that. But if you had invested every single dividend for the past 54 years, gold is still outpaced the Dow and the S&P. Silver came in just behind those at number four, but it goes to show the old adage that Wall Street wants us to believe that because there's no yield on gold, you should have known it. It's actually a joke.
If you price things in gold, you get to see what they really are priced. He says we've been in a bear market for 2 decades on the stock market.
Yeah, in just about anything that you measure it against. In all valuations, don't measure it against the dollar, measure it against gold, and you'll see that in terms of gold, things are getting cheaper. I expect that the price of gold only goes higher because, as Michael Oliver, who you have on your show all the time, he's talking about a real massive capital rotation from Western mainstream legacy investment stocks, bonds, etc., into precious metals. He says this happens but once only every 50 years. Doing a little bit of reading this weekend, found it very interesting that before Scott Bessent became the U.S. Treasury, he wrote this. I'm going to read it from his January 2024 Key Square Capital Management letter. And then I want you to think about where we are right now today and his role in all of this. We believe that this, and again, he was writing this for a letter. He was a capital management letter that he was working for in 2024. We believe that this inappropriately easy policy, monetary policy they're talking about, inflated the dot-com equity bubble. Our best case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call the greatest 4 years in American history. In this scenario, here's the important part. The greatest risk factor, in our opinion, would be a sudden rise in long end rates. I find it interesting. I think this explains why he's so much into gold. And, this is where we're going. This is the path that we are heading on. I also found it interesting that Bessent just also advocated for a comprehensive independent review of the Federal Reserve. He called for scrutiny of the entire operation, its monetary policy, its regulation, its staffing, its communications, blah, blah, blah. He argues that the Fed has strayed beyond its mandate and needs to regain credibility as a non-political institution. He said that the Fed should relinquish its banking supervision duties and limit economic intervention, particularly unwarranted bond purchases outside of crises. But this aligns with President Trump's effort to increase influence over the Fed. So if that happens, you look at Stephen Mirren being put in and Trump's attempt to sever the independent. Isn't that exactly what Goldman Sachs was warning about? That the political control harms its credibility, increases inflation, undermines its trust. Bang, gold goes to 5,000. So it's happening right now. I mean, you can see it as being undermined. And so, I think that one should expect gold to go much higher in the face of a dollar going much lower and the Federal Reserve losing independence, as Goldman Sachs has so eloquently spoke of.
Andy isn't just talking about gold's price going up. He's saying gold is sending a warning signal to the entire financial system. In his view, gold's all-time highs aren't just a bull market story. They're proof that fiat currencies everywhere are losing purchasing power. When sovereigns, central banks, and big money funds start choosing gold over treasuries or bank deposits, that's not business as usual. That's a structural shift in how global capital is allocated. And that shift doesn't stop with gold. It spills into silver, which investors see as undervalued and as the natural companion to gold for storing real wealth. This is why we're seeing record hoarding. When institutional players physically pull metal out of the system, converting ETF shares into actual bars, locking them in segregated accounts, or taking them off exchange entirely, the pool of deliverable silver that backs paper contracts gets smaller by the day. And here's where it gets critical. With huge short positions still on the books, that shrinking pool can create a supply crunch. At that point, the story isn't just about price and demand. It becomes about logistics and control. Who has the bars? Where are they stored? And who can legally demand delivery? Those questions will decide whether this market stays calm or erupts into a full-blown price shock.
Oh, there's no question. You're seeing, the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But seven-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but is it the craziest thing to think of? If you take 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
Can you talk to us briefly about, and you did, but again, about the predicament that big money is having as they're trying to move out of the stock market, out of the real estate bubble, and they're going, where do I put my proceeds? What's the old bag of tricks? Why don't those work anymore? What are they looking at?
I mean, the old bag of tricks would be you put it into treasuries earning a fair rate of return and let the laws of compounding be your friend. Back in the day with 9% interest every 8 years, your principal would double. And if you had 9% interest and millions of dollars, that's fine. Double every 8 years. The law of 70 seconds, 9 into 72 is 8. Problem is that where we are right now, the inflation is far higher than the rate of return. And so a real negative rate of return makes bonds a no start. I mean, it's a no-go. And so then what? Do you put your money into an equity market where valuations are higher than at any time, even the 1929 crash of the stock market, anytime ever, at a period of time when you have the largest ever margin debt by the retail public, the largest ever exposure to options by the public, and the largest ever participation in the stock market by the public as the insiders are literally moving the other direction. You put it into real estate when 30 years worth of suppressed interest rates have created great distortions. And where do you put it? These are very, very crazy times. So where do you put your money? Because of the suppression in interest rates and the distortion of asset prices for all of these years, asset prices, to invest into assets right now at all-time highs, you have to wonder, do they continue to go higher? I just happen to believe that there are very few places that offer the kind of appeal right now, not always, but right now that gold and silver do. And I think you are seeing sophisticated investors wake up to that. Again, who the hell is taking possession of billions of dollars worth of gold and silver every single month? Now, when I say possession can be held in your personal storage account unencumbered in a COMEX vault, sure. Or it can be taken off the COMEX. Both are happening. But big money nonetheless. This is money that is not just big, it's sophisticated, it's well-informed. I think that's kind of the key. But when you see this, not only the front running by the central banks, whoever's doing it here in the United States, when you see the absolute certainty that you're going to see a devalued dollar and lower interest rates, which will, what's that going to do to the back end of the market? Are there ramifications in the banks? All these things are connected. And when you take a step back, the only place that I would put my money where most of these things, if they play out negatively, I think gold is a benefactor, silver too. But I think you don't buy to become wealthy. You buy because it is wealth, and the biggest money in the world is showing you there are very few places safely to put your money other than gold and silver. So that would be my choice. Forget about the fact that I own a company that does it. I'm trying to be completely objective.
A true silver short squeeze won't come just from retail investors. It will take a perfect storm of bigger forces. Steady inflows into funds that demand physical delivery, massive private purchases pulling bars out of the system, and a trigger event, like a sharp price spike, cascading margin calls, or a major player demanding delivery, could force counterparties to either post more collateral or hand over real silver. Because the supply of good delivery bars is limited in the short term, such a squeeze wouldn't just push prices, it could send them surging in a fast, non-linear spike. But let's be clear. There are guardrails that can delay or dampen this outcome. The paper market still provides liquidity and can suppress prices longer than fundamentals would suggest. Big players can source metal globally, mining and recycling add new supply over time, and regulators can step in with margin hikes or rule changes to slow things down. That's why a $700 silver price is possible, but not inevitable. It depends on how concentrated the demand becomes, how quickly buyers demand delivery, and whether the market can find enough metal in time. And the structure of the market matters. ETFs, futures, and custodial programs don't always mean true physical ownership. Only conversions into allocated bars remove silver from circulation and tighten the system. Even delivery itself isn't frictionless. Bar standards, vault logistics, and custodian cooperation all matter, especially when investors move from paper exposure to physical metal. And remember, silver isn't just money. It's a critical industrial metal used in solar panels, electronics, and manufacturing, which provides constant baseline demand. For investors, the key is not to bet on a straight line to $700, but to understand the changing risks, counterparty exposure, certainty of delivery, and where you store your metal matter as much as the price you pay. Build a strategy. Size your positions wisely, choose secure storage, and know exactly why you own silver. If this breakdown helps you see the bigger picture, hit that like button, subscribe for more, and drop a comment. Do you see silver's future as a slow revaluation, a violent squeeze, or a long, drawn-out battle between fundamentals and paper control?